Good morning, it's me, your host, Kenny Polcari, and it is Monday, February 27, 2023. What is it that's happening today? Well, as you can see, it is just another spectacular day down here in South Florida. The sky is blue, the sun is out, there's no wind, so we don't have that hassle that we had last week when I tried to do this outside. So what is it that we need to know, right? What happened last week? Well, stocks got smushed, right? We had the PCE report that came out, and it was stronger than expected. Okay, but I have to ask, was that really a surprise? Was that supposed to be a surprise? Why was anyone surprised at all is the real question. Bond yields rose, the dollar index rises, gold falls, right? Stocks also fell, right? They got smushed. Oil bounces off the low that we saw last week, and Goldman puts out another oil note over the weekend. 39.70 is now trendline support, and we're sitting right on it. So the question is, will we hold? And what do we have for dinner tonight? We're having the pan-fried thighs in a white wine sauce, all done in one pan, so it makes it very easy to cook and then clean up. Okay, so look, stocks got punished a couple of times last week, right? On Tuesday and then again on Friday. A realization that inflation is and will be more of an issue is finally hitting home. And Friday's PCE report not only made that even clearer, right? Friday's report showed that the Fed's favored gauge of inflation is rising more and faster than expected. The month-over-month number coming in at plus 0.6% versus last month's, which was up 0.1, but then was revised up to 0.2, not good. The year-over-year top-line number came in at 5.4% versus last month's 5%, which also got revised up to 5.3%. And when you go to the core PCE, which eliminates some of the more volatile sectors, what do you see? The same thing, right? Rising inflation beyond all expectations. And so that wasn't good at all, and it sent the sell algos immediately went to work, right? While the buy algos pulled their bids back and moved lower. Not out of the market. Just remember, they just decided to re-enter at prices that reflected a 1 or 2 or even a 3% discount from where they were trading the day before. By the end of the day, the Dow lost 336 points. The S&P gave back 42. The NASDAQ gave up 200. The Russell lost 17, and the transports gave up 80 points. But for the week, it was even worse. The Dow gave back more than 1,000 points, or 3%. The S&P lost 120 points, or 2.6%. The NASDAQ gave up nearly 400 points, or 3.4%. The Russell lost 56, or 2.8%, while the transports gave back a whopping 506 points, or 3.3%. Now, while I get the fact that the inflation report was stronger than expected, I have to ask, and I asked this again on Friday, did anyone really expect a different outcome, considering that the prior week's inflation data, both the CPI and the PPI, revealed the exact same thing? I'm actually just surprised at the reaction. It's not like we didn't know this, right? Or should I say, it's not like the humans didn't know it, because we knew it for sure. It was the algos that appeared surprised. And when they're surprised, what do we get? We always get an overreaction, because then the algos just go into overdrive, regardless of tone or environment, right? I mean, it's just crazy what the algos do. Now look, if you draw the trendline resistance from the highs of April 2022 to the high of January 18th, 2023, you'll see something very interesting, right? The trendline acted as resistance the whole way down, right? That wasn't until January 23rd of 2023. That's when it broke up and through that trend line and traded up to as high as nearly 4,200 on the S&P on February 2nd. After last week's action, though, guess where we are? We came right back down, except this time we're sitting on the trend line, right? Which is now acting as support versus resistance, right? Kavish? So this week is going to be key. Today is going to be key. The question is, are we going to hold that support and build, or are we going to pierce it and then fulfill the Morgan Stanley narrative? Remember, their narrative is S&P 3000, which is a 21% decline from the current levels, something I do not agree with. But it is what makes a market, right? Because then there's both a buyer and a seller debating on where the market should go. Look, the market is repricing risk. The path forward remains volatile, and all signs are telling you to be careful. It's just like JJ said back in January. Curb your enthusiasm. Higher stock and bond prices will make his job that much more difficult, right? If it's accompanied by continuing stubborn, sticky inflation. The thought here is that the higher asset prices will make investors feel wealthier and that they'll continue to fuel demand, something that he's trying to kill. So he's going to attempt to jawbone the markets lower while pushing interest rates higher. I suspect that it tests lower if and when it comes. We'll see us test the S&P 3600, which was the September-October 2022 lows, right? Which represents about a 9% pullback from here. And it feels much more realistic versus a 24% pullback that Mikey Wilson's calling for. But look, so much can happen. We're starting to see inflation rear its ugly head, and that was a concern that I told you months ago. In any event, there's a lot of eco data this week coming right at you, right? Durable goods expected to be down 4%, a stunning reversal from last month's plus 5.6%. Pending home sales of plus 1%, but with mortgage rates rising and housing prices falling, I'm betting that we're going to see a negative number. To confirm that, we're going to get the FHFA housing price index, which is supposed to be down 0.2%. By the end of the week, we're going to get reads from the Dallas Fed, the Chicago Fed, and the Richmond Reserve banks, and they are all expected to suggest lower numbers, right? So again, a weakening economy from different parts of the country. Oil, oh wow, would you look at that? It's trading at $76.80 this morning. It's up 4% or up $3 off of last week's low after trading down and finding support down at the $73.80 level, a level we discussed. Our friends at Goldman, though, put out another note over the weekend telling investors that OPEC has elevated pricing power when it comes to oil prices. Oh my God, wow, Goldman, what insight you have. Their analysis, though, once again, plays on both sides of the fence. This way they can always point to something and say, look, we were right. On the one side, they're calling for OPEC to reverse their supply cuts in June, right, when it's expected that demand is going to exceed supply, putting the market into a deficit, forcing prices higher. Brent crude at $90 and WTI at about $83, which is up 9% from here, is what they suggest, right? But then they tell us, don't be so sure. OPEC could decide to do nothing, keeping those production cuts firmly in place because West Texas Intermediate at 83 and Brent crude at 90 may not be high enough for OPEC, for them to require a move by OPEC, right? For OPEC to consider changing their production levels. Remember, the sweet spot for Saudis is to have WTI trade at between $80 and $90 a barrel, and for Brent to trade between $90 and $100 a barrel on average for the year, which means it needs to trade even higher to get that average up, because so far the trading range this year has been between $73 and $84 for WTI, leaving it well below what they want. And since they are the swing producer, they hold the key. Now, if they keep supply cuts in place and demand rises, then Goldie says that we're going to see Brent trade as high as $107 a barrel and WTI trade to about $100. See how that works? Again, it's all supply and demand, Econ 101. And to think we have plenty of our own oil right here in this country. We were the swing producer during the prior administration. We are no longer in that position. WTI was trading, remember, at $46 a barrel when Joey took over, only to see it rocket higher by 132% to trade as high as $103 a barrel in June of 22 before backing off about 24% as of this morning to trade at $76.80. In any event, I would expect that we're going to see oil prices move higher as we go from winter to spring. Gold continues to come under pressure as the inflation story remains hot, hot, hot. Remember, strong inflation is going to force the Fed to raise rates, and that's going to force the dollar higher, putting pressure on the precious metal. Remember, gold surged higher by 8% during the January move as the dollar index fell by about 4% during that same time, when all the talk was about how the Fed was going to pause and then pivot, and then they succeeded in controlling inflation. How's that working for you, right? Not so good. Apparently, they have not controlled inflation. Rates are going higher. The pause has been pushed out to at least until June, and the pivot ain't happening. Gold has given up all the gains from the January move, and the dollar index has taken back all the losses from the January move. Now, if the dollar continues to push up, then expect gold and other precious metals to push lower. $1,800 is the key to watch for gold, which is currently trading at $1,815, while 106.50 is the level to watch for the dollar index, because that's currently trading at 105.70. So if it pushes up and through there, then expect a further push to gold and other precious metals. The bond market is also forecasting higher rates, right? The 3-month T-bill is yielding near 4.7%. The 6-month bill is yielding 5.14% on an annualized basis, while the 2-year is yielding 4.84%. The 10-year is kissing 4%. 1-year CDs at the bank are paying you nearly a little bit better than 5%. 30-year FHFA mortgages are now hovering near 6.7%, up from 6.2% last month, when it was expected that the Fed would stop pushing rates higher. In any event, it continues to be a volatile time for investors and for the markets. Expectations for a terminal, which is a neutral rate, are now anywhere between 5.5% and 6%, depending on who you're talking to and what day of the week it is. And now there's even some chatter that the terminal rate might have to go even higher. I am not in that camp. I am not. But there are some that are now trying to push the expectation higher. And if they do that, it's going to put upward pressure on yields and downward pressure on bond prices and downward pressure on stock prices. It'll put upward pressure on mortgage rates and downward pressure on housing prices. It'll put upward pressure on the dollar and downward pressure on gold, right? You see the pattern there? I can repeat it if you want, but just go back and listen to it again. Right, and just on a side note, they tell us that the Fed is succeeding in taming inflation because used car prices and housing prices are coming down. Well, of course they are. The loan rates to carry houses and carry used cars are going up. So prices have to come down to reflect the higher rates. But what they're missing is that the cost to carry the house and the car is still going up, right? No matter what the prices are doing, because they haven't come down far enough yet to balance that out, right? I suspect that we're going to see further downward pressure, right? Do you realize that auto companies, right? You go in to buy a certified pre-owned used car and they're running credit at 10% rates for used cars and offering to finance out 72 months to make it affordable. 10%, think about that for a minute. A $25,000 used car loan for 6 years at 10% is running $463 a month. And if you opt for 5 years, it jumps to $531 a month. And a 4-year loan will cost you $635 a month. So let that sink in. And then if you want to know why used car prices in decline, just think about that rising cost. And let's not even discuss new car prices and financing options with car prices, in the $70,000, $80,000, and $100,000 range. U.S. futures are up this morning after the beating they took on Friday, which, like I said, was a little bit of a surprise to me, considering that we didn't learn anything new. Inflation is sticky and rates are going up, and we already knew that. This morning, Dow futures are up 140, the S&P's up 20, the Nasdaq's ahead by 70, and the Russell's up by 10. We're sitting, like I said, right on trendline support. I pointed that out at the top of this video. So a bounce from here would be seen as a positive, at least for today, right? The conversation and the eco data this week is going to help sort out what comes next, right? European markets are also higher this morning, right, after getting beaten up last week. They're up better than 1.25% today across the board. European investors are now pricing in an ECB peak rate of 3.75%. Currently, they stand at 3%. So they, too, are expecting ongoing rate hikes through year end. And ECB President Christine Lagarde has also been very clear about this. So no one in Europe or elsewhere should be predicting an ECB rate cut anytime soon. Eurozone economic and consumer confidence is also due out later this morning, so we'll see how that impacts investor psyche over in Europe. The S&P on Friday ended the day at 3970, which was down 43 points, but which was up from the low of 3943, which is sitting right on the 200-day moving average trend line. Remember, we're sitting on this other resistance trend line at 3970. We're sitting right on it. The 100 and 200-day trend lines are just a hair below at 3914 and 3940 respectively, right? My sense is that we're going to see some consolidation for stocks this week as we digest the most recent data and digest the most recent Fed speak. There are no Fed speakers that are scheduled to make any formal presentations this week, but it doesn't stop any one of them from opining on the market action or opining on Fed thought if anyone asks them. Remember, the market wants clarity. That's all it wants. Good or bad, it just wants clarity, right? So in the end, you need to know what you own and why you own it. If the fundamentals for what you own have changed, then you got to reconsider the base case, right? If you're nervous, then take some of the cash you have and just put it into short duration treasuries for now, and that's going to help you sleep at night and give you some stability, right? Don't forget to add some of those contra names if you're really worried about a market sell-off that offer downside protection. Remember, the market has never stopped going down while the Fed continues to hike. So expect more volatility and pressure on the markets at least until June, right? We've been discussing this, but that doesn't mean it's going to collapse by any stretch, right? It just means we could see some cheaper prices and maybe some solid names which will offer opportunity to the long-term investor, right? I think of names like Apple, Amazon, Microsoft, IBM, JP Morgan, Bank of America, Verizon, all those names that will offer stability, and they are good quality mega cap US names. Okay, so what do we have for dinner time? We're having the pan-fried chicken thighs in a white wine sauce, all done in one pan, right? It's a great dish. And it's easy to make and it's easy to clean up, right? First, start by preheating your oven to 300 degrees. This will just keep the chicken warm while you're finishing the sauce, right? You want chicken thighs with the skin on. You want sea salt, you want black pepper, vegetable oil, you want 2 or 3 shallots, sherry vinegar, some Pinot Grigio or some other dry white wine that you like. You need fresh rosemary, parsley and thyme, chicken stock, and butter. You want to start by rinsing and patting the thighs dry, season it with the sea salt and the pepper, and then just set it aside just for a moment. In a large saute pan, you want to heat up the vegetable oil until it's nice and hot. Now you're going to take 3 or 4 pieces of the chicken thighs and put them in the hot oil, skin side down at first. Let it cook until it's golden brown. You know, it usually takes about 7 to 8, 9 minutes, right? Depending on the size of the pan, depending on how many pieces of chicken you have. Don't let them burn. That's just be careful. Lower the heat if you have to, if it's too high. After 7 or 8 minutes, flip them over, repeat, cook on the other side, right? When it's done, you're going to take the cooked chicken pieces, put them in a Pyrex dish, and just put them in the oven so they stay warm while you repeat finishing the other chicken and you make the sauce, right? Now, if you got a lot of fat from the chicken, you can empty some of it out. If there's not too much, you just leave it because that will provide some flavor. Now, after you've done with the chicken, you want to add the thinly sliced shallots and saute it in that same pan for 2 or 3 minutes. Now you're going to add 2 tablespoons of sherry vinegar. Scrape the bottom of the pan to get all the bits off. Now you're going to add 1 cup of the white wine. Let it come to a boil. Let the alcohol boil off. Reduce it to a simmer, and then add a half a cup of chicken stock. Let it simmer for about 5 or 7 minutes. Do not let it evaporate. Otherwise, you've gone too far. You can always add more if it starts to evaporate, but turn it down to simmer. Now, stir in the chopped herbs and the stick of butter, right? Once it's all melted and blended, place the chicken on individual plates and then pour some of the sauce over the chicken on each plate. Enjoy this with a large mixed salad dressed in salt and pepper, dried oregano, olive oil, and fresh lemon juice. Its simplicity is what's best. And then enjoy this with the remaining bottle of white wine that you use to cook it. In any event, it's easy to make, simple to make. You make the whole thing, and you know, maybe it's going to take you 35 or 40 minutes from start to finish if you concentrate and you do it right. In any event, it is an absolutely stunning day here in South Florida. It's going to be about 80 degrees. The sky is blue, the sun is out, so maybe it portends that we're going to have a relatively stable market. Listen, until tomorrow, I am Kenny Polcari. Take good care.